Assalamualaikum warahmatullahi wabarakatuh, and morning, good afternoon, and good evening to those who who are here and watching my video. And I would like to present my thesis entitled "Environment, Social, and Government Performance and Firm Performance During the COVID-19 Pandemic: Evidence from Emerging Countries in G20." First, I would like to begin from the first chapter, the introduction. That allow me to begin from the objectives. Environment, social, and governance, or we should call it ESG from now on. ESG activities has become a central topic and is also considered important for decision making for policymakers, investors, and corporates. Investors attach importance to a firm's ESG performance for several reasons. First, by firms investing in ESG activities, ethical activities can be actively promoted and thus increases ESG performance. Second, the performance of a firm's portfolio can be enhanced through investing in ESG activities. ESG activities increase returns and reduce the risk of portfolios of a firm, which can result in higher firm performance. Thus, investors are likely to invest more on firms with high ESG activities. In early 2020, there was a COVID-19 pandemic, which later led to global financial crisis. This COVID-19 pandemic has an extreme impact on companies' performance around the world. The response of the market to this pandemic is unparalleled when compared to previous major outbreaks like the Great Depression and the Spanish flu epidemic. This study, or my study, investigates whether ESG performance led to a better firm performance and how it is affected by the COVID-19 pandemic crisis. According to a survey conducted by the United Nations Global Compact in 2013, approximately 93% of the chief executive officers or CEOs from around the world who participated acknowledged the significance of ESG issues for the success of their respective business. Empirical studies on the COVID-19 pandemic and firm performance only studied the effect before and after the pandemic. Following Hu and Zhang 2021, this study took a novel approach to gauge COVID-19 pandemic by accumulating the number of COVID-19 cases. This measurement can record the genuine effects of COVID-19 pandemic on businesses by recording the severity of COVID-19 pandemic. The study also investigates the impact of ESG activities on firm performance in emerging countries listed in G20. Previous studies investigated the effects of ESG in the settings of cross-country. While previous studies studied the effect of ESG in the settings of cross-country, they did not study this effect on the settings of emerging and G20 countries at the same time. G20 countries are countries leading the global economies. However, while they lead global economies, these countries also significantly contribute to global carbon emissions. Emerging countries are responsible for a substantial number of imports of goods and services from developed economies. Emerging countries has been investing at an increasing pace to keep up with the competition of developed markets. Therefore, it is essential to examine the effect of ESG performance on firm performance in emerging countries listed in G20. Next, I would like to talk my development of research question. The first research question: companies follow a pollution prevention strategy when companies decrease their GHG emissions rather than a pollution capture and remediation strategy. Through operational efficiency, this strategy leads those companies to save costs. However, the extent to which firms can immediately benefit from these cost savings remains uncertain. This uncertainty implies that the relationship between proxies for environmental and financial performance may be negative. Prior studies suggested that ESG serves stakeholders in the long-run perspective. Alan and Hamdan 2020 suggested that significant resources should be allocated to ESG activities as the returns on ESG investments are not immediate but rather realized after reaching a certain threshold of ESG implementation. Korvatova 2012 revealed that while the impact of environmental performance on financial performance is negative when considering a lag of 1 year, it becomes positive for a lag of 2 years. This finding suggests that environmental performance is positively associated with firm performance in the long term. So based on the background I mentioned earlier, The research question is, how does ESG performance affect firm performance in the long and short term? Next research question, COVID-19 pandemic heavily affected firm activities. The severity of COVID-19 pandemic on the market is affecting and harm companies substantially. Harvard et al. 2021 found that social enterprises crowdfunding faced significant challenges during the pandemic. Startups and small-scale businesses in China had a 60% decline in investments in equity in the first 3 months of 2020. Aman Kuamoa 2020 found that corporations could deprioritize environmentally sustainable policies and initiative costs. This is due to the companies were facing a financial crisis caused by COVID-19 pandemic, undermining planetary survival. However, the company's efforts by being more environmentally friendly and transparent about its sustainability activities during the pandemic can lead to reduced market risks in environmentally responsible businesses. Previous literature also found that after the fall of the markets in late February 2020, funds with lower risk from high ESG performance were more preferred. Investors saw lower risk from high ESG performance as hedging against the market downturns. Contradictory findings have been reported in studies on ESG and ethical portfolio performance during the COVID-19 pandemic. So based on the background I mentioned earlier, the next research question is, can COVID-19 affect the relationship between ESG and fair performance? Next, I would like to talk about my research contribution. This study contributes to accounting literature on the topic of ESG performance and the COVID-19 pandemic. Specifically, the study examines of how ESG performance and the COVID-19 pandemic can affect the performance of a firm. As mentioned earlier, most research on COVID-19 pandemic and firm performance only studied the effect before and after the pandemic. Following Hu and Zhang 2021, the study took a novel approach to gauge COVID-19 pandemic by accumulating the number of COVID-19 cases. This measurement can record the genuine effect of COVID-19 pandemic on businesses by recording the severity of COVID-19 pandemic. The study also contributes to international and cross-country accounting literature by presenting research in a cross-country setting. Previous studies investigated the effect of ESG in the settings of cross-country, while previous literature studied the effect of ESG in the settings of cross-country. They did not study this effect on the settings of emerging and G20 countries at the same time. Next, let us move to the second chapter, the theoretical background and the literature review. First, ESG on firm performance. This study uses stakeholder theory to predict whether firm performance is affected by ESG performance. Stakeholder theory establishes the connection between an organization and its stakeholder. Business sustainability acknowledges stakeholders or as individuals or groups who possess the ability to influence or be influenced by the activities of business. ESG disclosure is a way to communicate on organization's performance to the interests of various stakeholders. So, drawing from this theory, it is suggested that companies should strive for maximum transparency by disclosing not only financial information, but also non-financial information, specifically ESG disclosure in this context. By doing so, companies can minimize informational asymmetry with the general public, leading to higher levels of investor confidence and consequently impacting the company in a positive manner. Next, I would like to talk about my the literature review. Fidi et al. 2015 found that 90% of approximately 2,200 studies have a neutral or non-negative association between ESG and fair performance, with a significant number showing positive results. Over time, results of studies in ESG and fair performance have predominantly shown positive associations, with variations observed across portfolio and non-portfolio studies, regions, sectors, and asset classes. They also found mixed results in the previous studies they reviewed in the previous studies. They reviewed individual E, S, and G scores or ESG scores. While previous studies studied the effect of ESG in the settings of cross-country, they did not study this effect on the settings of emerging and G20 countries at the same time. Next, the hypothesis development. This study examined the effects of ESG performance on firm performance on two complementary financial performance measures following Siddiq et al. 2021, the short and the long-term measures. The financial performance in the short-term measures examines the current performance of a firm, while the long-term measure emphasized more on their future performance. Companies follow a pollution prevention strategy when companies decrease their GHG emissions rather than a pollution capture and remediation strategy. Through operational efficiency, the strategy leads those companies to save costs. However, the extent to which firms can immediately benefit from this cost saving remains uncertain. In the same vein, Saigili et al. 2022 investigates the effect of ESG disclosure on corporate financial performance at Turkish firms and found a negative effect of environmental disclosure on corporate financial performance. So, based on the theoretical and prior literature review I mentioned earlier, most previous studies are leaning towards negative results in ESG disclosure on the firm performance in the short term. Therefore, I would like to propose a hypothesis as follows. ESG performance has a negative impact on firm performance in short term. Next, prior studies suggested that ESG serves stakeholders in the long run perspective. Al-Rani and Hamdan 2020 suggested that significant resources should be allocated to ESG activities, as the returns on ESG investments are not immediate, but rather realized after reaching a certain threshold of ESG implementation. Horvatova 2012 revealed that while the impact of environmental performance on financial performance is negative, when considering a lag of 1 year, it becomes positive for lack of 2 years. This finding suggests that environmental performance is positively associated with firm performance in the long term. These prior studies justify this study examining the effect of ESG performance on the long-term firm performance. Based on the theoretical and prior literature I mentioned earlier, most previous studies lean toward the positive results in ESG or disclosure towards the firm performance in the long term due to its prospects. Therefore, I would like to propose my second hypothesis. ESG performance has a positive impact on firm performance in the long term. Next, COVID-19, ESG performance and firm performance. I would like to talk about my third hypothesis development. Research is limited, but exists in the topic of the definitive role of ESG activities in times of crisis, especially during COVID-19 pandemic. For example, research by Lins et al. 2017 found that U.S. non-financial organizations with high ESG ratings outperformed other firms during the global financial crisis, or GFC, in 2008 to 2009. As for how ESG performed during COVID-19 pandemic, Roadstock et al. 2021 conducted a study that explored the impact of ESG performance in the context of COVID-19 pandemic. They utilized a unique dataset encompassing China's CSI 300 constituents and discovered that portfolios with high ESG ratings tend to outperform those with low ESG ratings. Moreover, they found that ESG performance helps mitigate financial risk during times of financial crisis, while its significance is diminished during more stable periods, affirming its added importance during crises like the COVID-19 pandemic. In addition, Huang et al. 2020 found that firms in China with higher rates of CSR faced less loss and took a shorter time to recover from the COVID-19 pandemic. As a result, firms are more likely to outperform other firms during COVID-19 pandemic due to having better ESG performance. So, based on the prior literature I mentioned earlier, most prior studies suggested that firms are heavily affected by COVID-19 pandemic. Therefore, I would like to propose my third hypothesis. Firms affected by COVID-19 pandemic and has high ESG performance is likely to have better long-term firm performance. This is my research framework, as you can see. Next, I would like to talk about. I would like to move to my third chapter, research methodology. First, I would like to talk about the sample. The sample of the study comprised firms from emerging countries included in G20. G20 countries are leading global economies and are contributing global emissions significantly, which would affect environment in the end. Emerging markets are responsible for a substantial number of imports of goods and services from developed countries. The sample selection criteria are 1. Companies or firms listed from emerging countries from G20. 2. Companies or firms with available data to be tested within the time of period of interest. And as you can see, the time of period is the time of period of the period of interest is 2020 to 2021. These are the models used to test the hypothesis. And these are the description. The first two hypotheses are analyzed using multiple linear regression, while the last hypothesis is analyzed using moderated regression analysis. Based on Ghazali 2016, MRA or moderated regression analysis is a specialized technique used in multiple regression analysis, where the regression models includes an interaction between two or more independent variables. This analysis aims to examine the moderating variable and assess whether it intensifies or diminishes the relationship between the independent and the dependent variables. Next, I would like to talk about my dependent variable in this study. The dependent variable of the study is firm performance. There were two types of firm performance measurement, namely the short term and the long term. ROA is regarded as a short-term financial performance or return on assets, as it focuses on current costs and relevant revenues stated in the financial statement, reflecting immediate returns from profitable investments. On the other hand, Tobin's Q is considered as the measurement for the long-term performance. This measurement is employed due to its inclusion of intangible assets and its alignment with investors' enduring perception of a firm's sustainability. Next, the independent variable. The primary explanatory variable in this study is ESG performance, proxied by the ESG score, obtained from Thomson Reuters. ESG disclosure has been commonly voluntary and viewed as an expression of transparency and accountability. Thus, ESG score reflected a firm's specific level of ESG disclosure. The other independent variables used in this study are explained right here. Moderating variable. The moderating variable for this study is the COVID-19 pandemic. This variable was measured by the logarithm of cumulative COVID-19 pandemic cases in each country the firm resides. This proxy was chosen due to its ability to measure the severity caused by the COVID-19 pandemic. Moreover, this proxy was used in a prior study by Hu and Zhang 2021 regarding the impact of COVID-19 pandemic on firm performance and resulted in negative results. The cumulative COVID-19 pandemic cases can be obtained from World Health Organization or WHO. The control variable. This study included several firm-level control variables. The variables were firm size, leverage, capital intensity, growth, and beta. These variables were included due to their potential to impact financial performance. The data regarding these variables can be obtained from Thomson Reuters. Next, let us move on to the fourth chapter, results and discussion. Allow me to begin from the statistics. Discrete statistics for each variable used in testing the hypothesis are summarized in this table. The variables include ROA, Tobin's Q, ESG score, firm size, leverage, capital intensity, growth, beta, and number of cumulative cases of COVID-19 in every country. There were 2,434 observations representing 1,217 firms from the 9 countries with 2-year sample period from 2020 to 2021. The 9 countries were China, India, Russia, Indonesia, Brazil, Turkey, Mexico, Republic of Korea, Saudi Arabia, Argentina, and South Africa. The minimum and maximum values of ESG score are owned by the firms from Brazil, or the name of the firm is spelled Atacadão SA in the year of 2021, and Turkey, Arçelik AS in the year of 2020 and 2021, respectively. Consequently, the country with the minimum and maximum of cumulative COVID-19 cases are belong to Republic of Korea in the year 2020 and India in the year 2021, respectively. Next, I would like to talk about my hypothesis test result. The result of the hypothesis test, along with the further additional tests, are presented. Uh, the result of the hypothesis test are presented in this table. The first two hypotheses are analyzed using multiple linear regression, while the last hypothesis is analyzed using MRA. H1 predicts that the ESG performance has a negative impact on firm performance in the short term. It was found that the regression coefficient of ESG score was 0.000, as you can see right here. This means that the rise of 1 point in ROA resulted in a rise of 0.000 in ESG score. The t-value of ESG score was 2.421 with a significance value of 0.016. It can be concluded from this result that ESG performance has a positive impact on firm performance in the short term. Therefore, H1 of the study is rejected. H2 predicts that ESG performance has a positive impact on firm performance in the long term. The regression coefficient of ESG score was 0.002. This means that the rise of 1 point in Tobin's Q resulted in a rise of 0.002 in the ESG score. The t-value of ESG score was 0.759 with a significance value of 0.148. Although ESG performance has a positive impact on firm performance in long term, the significance value shows that the association between ESG and long-term firm performance is significant. Therefore, H2 of the study is rejected. H3 predicts that firms affected by COVID-19 pandemic and has high ESG performance is likely to have better long-term firm performance. I used MRA to test this hypothesis in this table. The regression coefficient for variable COF ESG, as you can see down here, is 0.008 with a significance of 0.000. It can be concluded that COVID-19 variable as a moderating variable was significantly affecting the association between ESG and firm performance in the long term with positive coefficients. Therefore, H3 of this study is accepted. These are the summary of the hypothesis test result. Additional tests. The study also used another measurement for COVID-19 pandemic as the moderating variable for further additional tests. The additional test was conducted using dummy variable as the COVID-19 pandemic variable measurement, where the score 0 represents the year where country C have no COVID-19 cases, while score 1 represents the opposite. Consequently, to complement the data, the period of interest was increased to 2018 to 2021. This model was analyzed using MRA, just like in the model 3. In this table, it was found that the regression coefficient of COF ESG was 0.003 with a significance of value of 0.304. The significance value shows that the COVID-19 pandemic does not affect the association between ESG and firm performance in the long term. Therefore, this additional test result did not confirm the result in the H3 test result. Now let us move on to the fifth chapter, the conclusion chapter. I would like to discuss about the hypothesis test results first. These findings of H1 were the same as stated in the bibliometric analysis by Khan 2022, stating that there is positive correlation between ESG performance and financial performance, size, and leverage. This result implied that based on the significance of market risk, sensitive industries conduct better ESG performance. This conduct was due to corporations insisting on protecting their reputation by disclosing more information, or in the study context, ESG disclosure. Regarding the positive association between ESG and long-term firm performance, this result is in line with the study by Alarani and Hamdan 2020. The results suggest that ESG disclosure have a positive effect on Tobin's Q. From this result, it was implied that ESG activities are beneficial for shareholders in the context of long-run planning. Significant resources should be allocated to ESG activities, as the returns on ESG investments are not immediate, but rather realized after reaching a certain threshold of ESG implementation. The result of this study suggests that during the COVID-19, firms with higher ESG performance have better firm performance. This is due to ESG activities can increase returns and reduce risk of portfolios of a firm, which can result in higher firm performance. Lins et al. 2017 showed that US non-financial organizations with high ESG ratings outperform firms during GFC or global financial crisis. In addition, Rubani et al. 2021 discovered a positive correlation between global COVID-19 pandemic fear index or GFI and ESG determinants during the course of the pandemic. This aligns with the notion of ESG indicators exhibiting safe haven characteristics amid the COVID-19 pandemic. Last but not least, I would like to talk about my research limitations and future research suggestions. First limitation relates to the size of the sample. Compared to the initial number of the firms from the 9 countries, the final sample of this study was reduced due to the limited numbers of firms with available data. This sample size may potentially limit the validity of the results. Therefore, this study may extend using a larger sample size from a far more broader criteria of the country used in the observations. The second limitation relates to the size of the firms used in the observation. This study focused on large-sized firms. Small, medium-sized, and private firms might be affected by ESG performance differently compared to large-sized firms. Future research may extend using small or medium-sized firms as an observation data. The third limitation also relates to the firms used in the observation. Different types of industry of the firm might be affected by ESG performance differently. For example, the association between ESG and firm performance might be higher on sensitive industry firms rather than non-sensitive industry firms. Future research may extend using types of industry as a control variable. The fourth limitation of the study relates to the measurement of ESG performance. Alarani and Hamdan 2020 stated that one of their key study limitations is that the ESG score do not consider the kinds of ESG disclosure a firm uses. Hillman and Kame 2001 demonstrated that various forms of ESG can have varying impacts on firm performance. Furthermore, when different types of ESG disclosure are aggregated into a single score, it is possible for the combined effects to negate each other, making it challenging to determine the true effect. Therefore, for future research study, the study may extend using different individual E, S, and G scores as the measurement for ESG performance. Another limitation relates to the measurement of ESG performance. Using Thomson Reuters database, I was able to obtain the data regarding ESG score of companies. However, there is a possibility that some firms did not make it to become the sample of the research, even though they practice ESG activities. This might happen due to the bias within the standards of ESG scoring of Thomson Reuters. Future research may overcome this limitation using other databases to complete their observation data regarding ESG score of the companies. Lastly, the last limitation of the study relates to the COVID-19 pandemic variable measurement. The extent of the pandemic severity could be influenced by specific policies or actions implemented by each country, and it can be argued that the measurement of COVID-19 cases may be susceptible to the classic issue of endogeneity. Thus, future research may extend by narrowing the period of interest to quarterly data of the year so that this measurement can be less contaminated by government's policy intervention. That will be all my presentation for my presentation of this thesis. Thank you for watching and greetings. Assalamualaikum warahmatullahi wabarakatuh.